Good morning, everybody. Thanks for joining me today. It's May 20th. And are we having fun or what? Dow's up at 40,000. The S&P 500 is over 5,300. The only problem is I may have to start working again here. We were expecting the market would get up to 5,400 by year end, but it looks like it could do it by the end of this week, if not by the end of the year. Meanwhile, it's the bottom line in terms of where this market's going. Point estimates sometimes are just interesting to convey some notion of where one thinks that the market's going. But I think bottom line is it's still a bull market. Still looking for 6,000 on the S&P 500 by next year sometime, maybe the end of next year, maybe sooner, and 6,500 in 2026. I've put out a QT, a quick takes, yesterday, speculating about where the market might ultimately be heading over the rest of the decade. We have been making decade calls since the beginning of the decade, talking about the roaring 2020s as one scenario. That's our base case scenario at 60% subjective probability. Productivity is strong, and all is well with the impact of that on real GDP and keeping inflation down, and boosting real wages and boosting profit margins. So where does the Dow go by the end of the decade in that scenario? And the answer we came up with is 60,000. So a 50% increase in the Dow from 40,000 now to 60,000 by left ourselves a little bit of wiggle room. We're using 1930, so basically at the beginning of the next decade or the end of this decade, we should be getting up to 60,000 in the 60% subjective probability scenario. Then, as we've discussed before, there's two other scenarios that each get 20%. There's the scenario where it's still bullish, but too much so. That's where we see the S&P 500 and the Dow just continue to climb here in the vertical direction. And not only do we get to our year-end target of 5,400 by the end of this week or by the end of next month, I guess they're a little too fast relative to our thinking of what earnings can do. So it's obviously valuation-led. And the valuation is already pretty pricey here at 2021 on the forward PE of the S&P 500. So if we get to 5,400 and then we start to all talk about 6,000 before the end of the year, I think that would certainly be viewed as a melt up. And that reminds us, of course, of the 1990s when we had a tech-led melt up that ended with a tech wreck and lots of tears. Then there's 20% for a bearish scenario, basically a repeat of the 1970s. That was a concern. Even not too long ago, it was a concern. But all in all, it seems to be less of a concern right now because of what the price of oil is doing. On the other hand, the price of copper is soaring, and usually when copper goes up, that suggests the global economy is doing well, and oil prices tend to go up in that environment, and that just isn't happening right now. So a geopolitical crisis, there's certainly at least a couple of awful ones out there between Russia and Ukraine, and between Israel, Hamas, and Iran, and that whole Middle East nightmare. And yet the price of oil remains subdued. If it were suddenly to take a jump to the upside over 100 to 120, that would be very reminiscent of the 1970s, and that would be the third 20% scenario. So clearly we're rooting for and committed to the idea that along the way things may go wrong, but on balance they'll go right, and we'll see that the economy continues to grow with nominal and real GDP going to record highs, with inflation remaining very moderate, partly because of productivity. Actually, the key driver of inflation is unit labor costs, and that's wage inflation divided by productivity. And so in our scenario, unit labor costs, which are already down to 2%, stay there and certainly help to keep a lid on inflation. What does the Fed do in that scenario? Well, I hope they don't do anything. I've suggested before that maybe they should just take the rest of the year off, maybe next year too. The idea being that they've normalized interest rates, or back to normal, and there's really no reason to lower them if the economy continues to perform well. If the economy is growing and inflation's down, why mess with success? So in my ideal world, the 60% probability scenario, the Fed recognizes that there is no need to lower interest rates and the economy can do just fine here. I know that there's people like John Williams at the Federal Reserve Bank of New York who've argued that if inflation continues to moderate and they don't lower the Fed funds rate, then the real interest rate goes up. I find that to be, well, frankly, a cockamamie kind of thesis, because, are we really taking a overnight interest rate, the Fed funds rate, and subtracting out a year-over-year inflation rate to get something called a real rate? Does anybody really make any economic decisions based on that kind of variable? I kind of doubt it. I won't make the same argument with regards to long-term rates. Real rates relative to 10 years, I think do matter, and inflationary expectations do matter relative to people borrowing money for a longer term period of time. But the bond market seems to have normalized. We've got a TIPS yield, a 10-year TIPS yield, a real rate in effect of 2.5%. We've got an expected inflation rate of about 2.5%. So add the minimums on those and the maximums on those, and you get a 4 to 5% bond yield, which is essentially where we've been for a while here. And there's no particular reason that couldn't continue. My concern is that if the Fed does come to believe that they have to lower the Fed funds rate, because otherwise the real rate goes up and the economy therefore might fall into a recession. In that scenario, they might very well lower interest rates, and then that'll be fine. I mean, the economy certainly would do well, and I don't think inflation would make a comeback for consumer prices. But asset inflation is a whole nother story. I think asset inflation, particularly to the stock market, could really go through that 1990s scenario, and then the Fed would, I think, regret that. But that's some thoughts on where we are and where we might be going. Let's look at some charts here. Max is here. You might have seen that Bailey was here, but she bailed out on us. Bailey bailed out. Max is doing what he usually does, takes a good snooze here. But let's go to the charts. Okay. There we go. So here we are. It's May 20th. How time flies when you're having fun, and we are having fun for now, and we could continue to do. One thing that worries me is there is a prominent bear on Wall Street who just turned more positive and is looking for 5,400 on the S&P 500 by year end. Somebody just forwarded that to me. So we need some bears here. That's the problem. We don't want all these bears becoming bulls. But welcome to our world of bulls right now, and let's hope we're all right about this thing. So here's a long-term chart of the Dow Jones Industrial Average. Let's play the slot machine here and see if we put in a quarter where this thing lands up, and see. Oh, here we go. There it goes. Lands at the same kind of chart, but with some lines on it, and it just happens to be figure 13. Don't ask me how that happened. So 13 should be a lucky number for us. And as you can see, here's the Dow going back in time with some growth targets. 4, 5, 6% is the kind of growth paths we see here. And what you see is that certainly during this period, the Dow was flat around 1,000. And so we've seen the Dow since 1982, which is basically when I got into the business in late 1979. I consider myself the quintessential baby boomer. I was born in 1950. So I'm sort of every decade coincides with a round number for me for my age. So here I was in 1980. Then the Dow was still around 1,000, and now we're up to 40,000. So in my career, that spans over 40 years, we've seen the market go up from 1,000 to 40,000. So it's a 40-fold increase, which is awfully impressive. And geez, I wish I had money back here and that I'd invested it all. But I'm not complaining. So as you can see, the Dow, well, since 2000 really, has had a nice rally here back in the 1980s, 1990s. Then after this 1,000 stall, then I guess you could say it kind of stalled here for a while, but it resumed, and here we are seeing back on a 6% growth target. And if we continue to hang along that path, we could be at 60,000 by 2030. And why might we do that? Well, that's would be certainly consistent with the roaring 2020s idea that the economy is doing well, inflation's down, profit margins are strong, and real wages are strong. In that kind of scenario, earnings should be an important driver of that. Earnings, by the way, let's have a look at this chart. It's all over the place, but I think we can get some logic out of it. As you can see in figure 14, we're looking at the year-over-year percent change in diluted reported earnings per share for the S&P 500. We have it back to the 1930s, and you can see the year-over-year is awfully volatile. So let's take the average over time. One of the neat things about our new charting system is we've got some functions that we didn't have before. And when you look at the average over time, the growth rate has been 8.8%. So, just on earnings growth, if that's what it is, why shouldn't it be better in a roaring 2020s scenario? Just on earnings growth, we should be able to get to 60,000. I kind of doubt that we're going to get there on valuation expansion because we're already at 2021, and that's rich. Maybe we'll have some correction along the way that brings it back down to something a little bit more affordable. And we all know that the Magnificent Seven account for a good chunk of that valuation multiple. Take them out, and you have something more like 17, 18, which is still a pretty high multiple, and one that it's unlikely to expand in order to give us a 40,000 Dow. But earnings can do it, and they can do the same thing for the S&P 500. And a 50% increase in the S&P 500 would get us to roughly 8,000 by 2030. So happy days are here again in our roaring 2020s scenario. Let's go back where we started before we put a quarter in the slot machine here. So here's the Dow without all the trimmings. Here's the S&P 500. Again, we kind of stalled out here around, it's like, about 100. And here we are at 4,000. So again, we've gone up 40-fold on that index as well. This all goes to the notion that stocks really do need to be held for the long run. They're tough to trade on a short-term basis. And if you look at this chart, you can see, recessions every now and then occur, and sometimes they can create a real havoc. I'm not telling you that it wasn't a good idea to get out of the market back here in the 30s, but a lot of investors seem to have been burned by that experience, though no one actually lived it. But that kind of crash historically makes it something that could happen again. And we've had a few crashes along the way here, and several recessions. But the recessions don't last very long, at least not since the Great Depression. And part of that is because we have people in Washington, D.C. who really, really care about us. They don't like to see the markets take a dive, and so they come in and bail things out. And so far, on balance, it's worked. I'm not telling you I'm in favor of that. I'm just being objective and saying it is what it is. Even the Chinese government has figured out that sometimes you have to really bail out markets, and that's what they're doing to their property market. I think the central bank is providing funds to purchase for local governments, provincial governments, to buy empty apartments and then to, I guess, rent them out. So we'll see how that plays out. But it certainly has had an immediate impact on the stock price indexes in the property market and the overall market over there. We can look at that briefly as we get to the end of this thing. Anyways, again, when you look at the big picture, things are, looking pretty rosy. The upside in the value of S&P 500, and again, that's gone up from $1 trillion around 1982 up here to $40 trillion. So there's something about this fourfold increase that is consistent across all of these major ways of measuring the market. Meanwhile, again, nominal GDP just keeps going up. Occasionally, it gets a little dip during recessions, but we're at a record high nominal GDP. You can see that another measure of our prosperity in this country isn't just that nominal GDP is at a record high, but also we're spending more on services relative to goods, which I think is a sign of prosperity. Once you've sort of got what you need in terms of non-durables and durables, if there's more left over for services, that suggests to me that we're prospering. It's when we're all kind of desperately trying to find non-durables and maybe buying some used durables that things aren't that great in an economy. But all in all, services as a high percentage, and a good chunk of that is healthcare, which again is a sign of a healthy economy. This is a controversial chart that I've shown before. It's I don't know why it should be controversial, but there's various ways of measuring the standard of living. And to me, if we look at incomes, if we look at wealth, you can certainly get into a big fist fight over income inequality in America. But I think a cleaner measure for measuring the standard of living is real personal consumption expenditures per household. The government does provide support from people with low income, and it does allow them to spend more. And so the question is this a realistic assessment of the standard of living when we take the average of real personal consumption per household rather than median? I don't have data on median. If some of you know where it is, I'd be delighted to see it. But there's only so many yachts and mansions that the 1% to 10%, whatever you want to call the higher incomes, higher wealth people, there's only so much that they can consume. And meanwhile, there's a lot more people that are not at that top end of the range. And as you can see, total real personal consumption expenditures per household, all-time record high. And that's been pretty much increasing at the same pace, even though you can argue the rich have been getting richer, at least in nominal terms. This is another sign that the economy is doing well, as reflected in the stock market. The stock market isn't the economy, but the stock market wouldn't be going up if the economy wasn't performing well over time. And you can see that even real wages, average hourly earnings divided by the consumption deflator, have been on an increasing pattern of about 1.4% per year in real terms, which is a doubling of the standard of living in. Guess what? The number 40 comes up again. Let's go to the track or to the casino and bet on the number 40. Profits, as we looked at before, upward trend. Again, another measure of profits that we looked at the year-over-year percent change in this series, upward trend along with the S&P 500. And then we've discussed this before, so I won't spend much time, but the rich have been getting richer because the baby boomers have been getting richer. Look at what the baby boomers had in in net worth. Back here, it was like, looks like about maybe at most $5 trillion. And now they're up to $76 trillion. So that's an impressive increase in net worth. The other generations are behind. The Gen X is catching up. There'll be a lot of inheritances that trickle down to the other generations. But one can expect that as long as we all continue to follow the dictates of the Vulcan salute, to live long and prosper, as Spock once said, just live long and invest along the way, and you'll prosper. Is what that's all about. So corporate equities and mutual funds. This does not include money market mutual funds. And you can see again that the baby boomers back here, this is the blue line. So they had virtually nothing in stock, and now they have over $20 trillion in stock. This is going back to the 1990. I mean, we're not talking about, going back in time at a tremendous uh, at a tremendous point in time in the back. Sorry, I just had a little Biden moment there. Let's see. So, real estate. This is owner's equity. This is what you own after the mortgage. And the baby boomers here have, you can see they've gone up to 16 trillion. So that's this one over here. And again, back in 1990, they had what, maybe 2 trillion? Live long and prosper. We looked at that chart. That was a happy one. We've looked at that one. These are just growth rates that the economy has been able to crank out. We've got this growth rate of 6.3% for nominal. In the roaring 2020s, there's no reason why we couldn't do better than that, or at least do less inflation and more real growth. And this is real growth, and you can see that's 3.1%. We're actually back to that kind of number. We had been, it's pretty consistently running around 3% even now. And so I think that continues to be a source of revenues growth. And then the question is, what does the profit margin do? Well, I spent some time in the morning briefing on the profit margin, and here's our forecasts for the profit margin. And they go up to record highs. So I think for a long time, people thought that the profit margin was pretty much of a cyclical variable more than it was a secular variable. But in the roaring 2020s scenario, we see the profit margin going to new record highs. This is another similar chart showing the forward profit margin that we just looked at in the red line for the S&P 500 versus something that comes out with productivity called operating profit margin. And sorry. Oh, let me just see. Oh, I'm sorry. I jumped ahead here. This is the quarterly and weekly profit margin. This is the actual quarterly profit margin, which is kind of bottoming. And this is the weekly profit margin used based on forward earnings and revenues. And you can see that looks like it's turning up, and we think it's going to continue to move up. And it's a good coincident indicator of the actual profit margin. So this is what I had in mind. I jumped the gun here a little bit. This is the operating profit margin for the S&P 500 versus the non-financial corporate unit profits, which comes out with productivity. So it doesn't have financials in there, but it is corporate. And the S&P 500 are a big chunk of the corporate sector. And you can see that there's a fairly relevant correlation here, not perfect, but you can also see that this measure of the profit margin has been an upward trend for quite some time, much more visible. And so we've got more history to it. And, you can see 50s, 60s, 70s kind of languished. And then starting in the 80s, 90s, it started to improve. Quite cyclical, obviously, but the trend is our friend here in terms of a higher profit margin. So GDP grows maybe the same, maybe more. If GDP grows the same, it'll be more real growth, less inflation in the roaring 2020s. But the profit margin would be rising to new highs, and that would drive earnings up. And so I'm thinking in terms of where earnings could go. We've been talking about 300 by 2026 for earnings per share for the S&P 500. Well, why not 400 per share by the end of the decade? And 400 times, let's take 20 as a forward PE, gets you 8,000 on the S&P 500. So the numbers, they work in a scenario where not everything goes perfectly right, but on balance, where things go quite right. It's the roaring 20s. It's not the melt-up scenario of the 1990s, tech melt-up followed by tech wreck, and it's not the 1970s all over again. Meanwhile, I keep taking an axe to the index of leading economic indicators, just arguing that it should just be retired. It's outlived its usefulness. It's misleading. I'll stick with the coincident indicators, all-time record high. This thing keeps predicting a recession. One day it'll be right, but it certainly hasn't been right over the past 2 years when people were looking to it for guidance. Remember I mentioned China before? China's stock market looks like it's starting to come out of its bear market. And this is the Shanghai Shenzhen. Shenzhen. I can't pronounce. I'm not too good with my accent. And this is a Shenzhen real estate stock price index, which took quite a dive here, and it looks like it's picking up here in response to the Chinese government's intervention. And maybe that's what copper was anticipating, is that the Chinese government would stimulate their economy by stimulating manufacturing and exports. So they would need more copper for all the electric vehicles they're going to dump in global markets. Everybody's concerned about that, but that's what they're doing. That's what they intend to do. And then meanwhile, maybe the demand for copper gets a little boost here if they are successful in stabilizing their property market. In any event, this shows the emerging markets MSCI index versus copper. We have the same kind of chart relative to the Chinese MSCI. And that's the story, folks. Let's take a couple of questions here. Let me see what we got going on the Q&A board here. And so far we have our usual turnout, but haven't had, oh, there we go. Okay. Let's take a couple more. Don't overdo it. Why does LEI not work anymore? That's from Tracy. The simple answer is it doesn't work anymore because if you take the year-over-year percent change in the LEI versus the Purchasing Managers Index for manufacturing, they're very, very similar. In other words, the leading economic indicators is very biased towards goods. And I've been saying, I've acknowledged that the goods economy is in a rolling recession. And we've been saying that for a while here. I think if I had to time it, it would be March 2021. Remember, we all went on a buying binge coming out of the pandemic lockdowns. We did that during the rest of the of 2020. And then apparently we did that through about March 2021. Here, the Ardeni family, we bought some outdoor furniture so we could eat outdoors in May. Then we bought a couple of sofas because we didn't like our old ones back in June of 2020. And then we realized that the color on the walls didn't quite match what we picked on the couches. So we repainted the walls and that's it. We're done. So we all went at least based on my experience, to the extent that I don't view myself as special or different, but maybe there's at least 75 million other people like myself, namely the baby boomers and plenty of others who very well must have done the same thing. We couldn't go traveling. We couldn't go buy various services. We didn't go to restaurants because there was still social distancing going on. So we had this buying binge for goods. And that basically, it didn't peter out. It just topped out in March 2021. The thing that kind of really blows my mind is that you would think that after all this binging on goods, that the next thing would happen is goods consumption in real terms would take a dive. It didn't do that. It just kind of stayed. It's been staying at a record high since then. So that's pretty impressive. So people did keep buying couches and outdoor furniture and all that, but they just didn't do it at an increasing pace. And meanwhile, everybody that pivoted in terms of wanting to spend more on things, they spent more on services, especially the retiring baby boomers, as we've discussed many times before, on things like going out to restaurants, traveling, healthcare services, and so on. So you put it all together, and the reality is that the LEI is just should be put out to pasture. There was an experience many years ago, I recall, when the LEI didn't work, and they recalled it. They put it back in the garage, and they came up with another version with different components and backward tested it, and look how well it worked. And then it stopped working once again. So maybe they'll take it back and retool it. Jeffrey, let me take the other glasses here. Jeffrey, what about the notion that high interest rates causing high mortgage rates leads to a dearth in housing starts, which then leads to low single-family home supply, higher home prices, housing inflation broadly, and sticky owner imputed rent specifically as a result. That's you covered it all. I think your question in some way answers itself because there's a lot of moving parts in the housing market. We've discussed them. Other people have discussed them. It's a very complicated, complex market. It's evolved. It's radically evolved, changed quite rapidly since the pandemic. First, everybody kind of seemed to rush out and want to get out of the cities and stop renting and buy a house. And if they couldn't buy it in a suburb, they went, uh, Green Acres. They went to the rural area. And then after about a year or so, some of them decided, nah, this is not that much fun. I'd rather be back in the city renting. Others moved down south. So the demand has been all over the place, and there's been a shortage of existing homes because the baby boomers, I guess maybe during the pandemic, said, it's not such a bad thing having a large house, especially if you have some family, you want to have them over. For whatever reason, the baby boomers aren't all dumping their big houses and buying smaller houses. I think younger folks that can't afford places like where I live in Long Island are moving to other places like Raleigh. I have a daughter in Raleigh. I have a daughter in Atlanta. So there are certainly more affordable places. And we're seeing people moving down south. And we did see a lot of multifamily construction. So the developers realized that all these people coming down would need to live somewhere, and they'd start out by renting before they actually went purchasing. But a lot of the construction has been down south. So, but when it comes to that owner-occupied rent component of the CPI, or let's take the one that makes sense, the tenant rent, the actual tenant rent, that's still moderating based on market measures of current leases. So I don't think we really have a problem there. I think rent inflation is going to continue to moderate. Maybe once it does so, the next problem we'll have is exactly what you're saying, is suddenly rent inflation will become a problem again. Chip, given the latest, I think Chip, this is the last question. Given the latest polling numbers for the leading presidential candidates, how do you think the markets are currently pricing in or evaluating their prospects of winning the election as regards to the stock market? Well, I think investors have learned over the years that you don't want to let politics get in the way of your investing. Whether you loved or hated Trump, loved or hated Biden, the market's gone up. And so it speaks to a point I've been making for quite some time is let's not forget us. Let's not forget us working stiffs who go to the office every day and or stay home and work from the home office every day and try to make our businesses better for ourselves, our families, our communities, our customers. May not be totally free market capitalism in America, but it's about as free as you're going to get anywhere, and it's still delivering a tremendous amount of prosperity. And witness the GDP numbers that I showed you and the productivity numbers that were strong last year. I think the economy is going to continue to perform well, not despite Washington, and but it could certainly get crazier in Washington, but the market's already figured that out and is learning to live with it. So that's my optimistic spin on it. I had an observation by somebody recently. Is like, how come I never worry about anything? Well, I challenge that. I kind of worried about and still do worry about what happened in the Middle East. I admit I wasn't too worried about inflation coming down, and so far so good. I have to admit I wasn't too worried about a recession occurring, and so far so good. So I think on balance, when you look at those charts, long-term charts, you see that optimism, at least for the stock market, on average works over time, and you just kind of sometimes have to grin and bear it through the bad times. I'm still working on calling bear market tops. I think I've got the bottoms pretty well mastered, but one of these days I'll give you a clear signal that you want to get out of the market. But then, of course, the onus on me, as it is on anybody who calls tops, is to tell you when to get back in. But On the other hand, you can do that all yourself. We're all professionals. We've all been doing this for a while, many of us. And at any rate, let's enjoy what we've got going on now and enjoy the rest of the week. All the best.